Let's start with some really basic principles. And these are real basic. They may be too basic for you, but it's good to have a good foundational grounding of really how do you make money in stocks? What's the underlying idea behind all this? And stocks are fun to trade and invest and watch them grow over time. I mean, I certainly enjoy that. But in the end, what we really want our stocks to do is make money for us so we can then use that money to fund our goals, fund our dreams, whatever that might be, buying a home, retirement, college education for your kids, whatever it might be. Stocks are a way to make money, and we want to learn how you can make money. And there's two big real ways that you can make money, and that's through growth and through dividends. So let's take a quick look at that. So first off, let's look at growth or capital appreciation, if we've heard that term, capital appreciation. And that's the classic, I buy stock low and then I sell it high, right? Who hasn't heard of that? Buy low, sell high. And that difference between what you paid for and what you sell it for, well, that's your profit. That's how much you've made. And so that's your growth. You want to buy low and sell high. And the interesting thing about stocks is it's a trade, right? If I'm buying a stock, that means somebody's selling a stock. They're trading, right? So I buy and you sell. That means you might not think too great about that stock, or you think there's better stocks, or maybe you're just cashing out to, then spend the money. But I'm thinking I'm going to buy that stock because I have high hopes for that stock. So, and I'm hoping it will grow over time and capital appreciate. So the stock market is a very interesting thing where you're bringing together buyers and sellers, and both have different points of views on the exact same stock or mutual fund or whatever it might be. Now, of course, the beware around this, of course, is that stocks can go down. Sometimes they can go down and never recover. I mean, when companies go bankrupt, their stock price goes down. Eventually, it gets delisted and they're bankrupt, and you're out your money, right? Maybe you got a little small claim, or maybe a little bit, but most times they go bankrupt. As a stockholder, and we'll learn about this, you're kind of out. So that's the thing. Stocks can go down, and they might go down. And you might want to sell them because they're going down, and then somebody else is buying it, hoping that it will rebound and go up. And we're going to learn about all things like that. So capital appreciation, right? Simple. Buy low, sell high. The other way you can make money in stocks is through dividends or income. You're basically getting regular income. It's very much a passive income thing. You don't have to do anything. By virtue of owning the stock, typically on a quarterly basis, you get a payout. The company that the stock you own pays you money. Wow, what a great thing, right? So even if my capital never appreciates, maybe even I might lose by the time I sell out on that stock, so I might not have any capital appreciation or growth. But if it's a dividend-paying stock, and not all stocks are dividend payers, but if it's a dividend-paying stock, it's going to pay me quarterly a regular check, basically, of income. And it's kind of a thank you for being a holder of the stock, but the big part of being a stockholder is you're an owner in the company. It's more than just a thank you. It's like, hey, you're an owner, and you're looking to take that money out of the business and then invest it in other things, or spend the money on something fun, or a home, or a vacation, or whatever you might want to spend the money on. So, but it's regular quarterly income. And so that's why a lot of people like dividend stocks, because even if they don't get that growth, they're at least getting some regular income from the dividend coming up. Now, some growth stocks, like a high-end tech stock or high-growth tech stock, might make so much in capital appreciation that overall it does much better than even if you have a great dividend-paying stock. And so that's the trade-off between growth and income, or growth and dividend-paying stocks. One beware around this, key beware around this dividend aspect is that companies don't have to pay a dividend. Now, companies like to pay a dividend. They've been paying it regularly. That's something they really promote, and people will buy that stock because they've been paying a dividend for 30, 40, 100 years in some cases. But at any moment, they could either reduce the amount of that quarterly dividend or the quarterly payout they'll give you, or eliminate it entirely, particularly when times are bad. We saw during the Great Recession of 2008, 2009, lots of companies were struggling, and just to stay afloat, not only were they laying off people and doing other things to reduce their expenses, but they were also reducing the size or eliminating their dividend. When they do that, it makes your dividend price, your actual price, what you paid for the stock, go way down, so you miss out on capital appreciation until it comes back up if you want to be a buy and hold type person, or you're missing out on that income that's coming in. So, there's a downside risk to dividends, but dividends are great to give you that regular income. That's why a lot of financially independent people or retirees like dividend stocks, because they get that regular check coming in that they use to help fund their retirement, basically. And then lastly, there's kind of like the in-between, right? There's like growth stocks and dividend stocks and things that, how you want to meet your goals with both those. But there's also, you might have heard terms like categories like growth and income. Maybe you've seen some mutual funds that promote themselves as a growth and income fund or something of that nature. And isn't that great? You get the best of both worlds, supposedly, all right? You get growth in the stock, they're looking at that, and then you also get some dividend paying too. And ideally, that's what we want, right? We want to invest maybe, let's say, in dividend stocks, but we want some growth as well if you want that combination platter. The challenge with that is sometimes companies that are really great on the growth end and they don't pay any dividend, well, that might be a better performing stock than a growth and income type of stock. Or stocks that are really, really good at paying a high dividend might not have that high in growth, but they pay a good dividend and it's a solid regular payer versus maybe something that's more in the growth and income kind of that combo category. So that's a basic overview. This is the pretty simple stuff, and then we're going to build from that. And when we start thinking about selecting stocks and looking at ratios and looking at things like, when you look at things like, can they continue to pay out the dividend? Things like a payout ratio is very, very important. But in a nutshell, as you go through everything in the course, understanding the different aspects of stocks and investing in stocks, underlying all of it is these two very big concepts of, is my stock going to grow up? Is my stock going to grow? Maybe it'll grow up too. Is my stock going to grow? And maybe it's mature. That's the growing up, right? So is it going to grow and I make money on that capital appreciation, or will it pay a dividend? And if you look at a life cycle of many stocks, they start as, maybe small companies, they don't pay a dividend, they have this high growth, and then when they get to a certain size, maybe then they've slowed down their growth and now they want to start giving back money in terms of shareholders, to shareholders in the terms of like dividends. A good example like that would be Microsoft, for example, high-tech company, right? So for the longest time, they invested all their money back in their company and had a lot of cash on hand, and they just grew, and they want to be like any other tech stock that wants to really grow, but they started reaching some maturation points. They had such cash on hand that they just really didn't know what to do with, so they started paying that out in dividends and rewarding those owners. So it went from a small startup from many decades ago to a high growth company, to a mature company, to a more mature company that's still growing, but also is rewarding shareholders with a dividend stock. So if you've held Microsoft, for example, since the beginning, well, you've been very well rewarded. But either way, you're looking at growth and income or growth and dividend as a way to make money in stocks. Did you know that I actually own Google? That's right, I own Google and Apple and General Mills and Johnson & Johnson and Wells Fargo, a big bank. I mean, I own all these companies. Isn't that something? Isn't that spectacular? Well, heck, you can own all those companies too, and that's really what a stock is. We're going to talk about. So what is a stock really? And it's really about ownership. You can be an owner. Now, I might have a few shares of these things, so I'm not worth billions of dollars like, some major shareholders. But heck, if I have one stock of Google, I'm an owner in Google, or an Apple or whomever. If I have one share, I'm an owner. I'm a small owner, but I'm still an owner. And basically, that's what a stock is. And we're going to talk about it from the perspective of a public company, something that's publicly traded that you and I can buy and sell stock in that company and be an owner and buy shares and be an owner in that company, or sell the shares and decide not to be an owner in that company, or maybe a smaller owner in that company. So that's what really stock is from a public standpoint versus, let's say, private ownership, or you're starting your own company or something like that. But publicly traded stock is about you having ownership rights. You're basically buying that stock or giving, in effect, the company money through, at least the original folks who were with an initial public offering. I mean, when they first bought in the company, they're an owner of that, and then you can sell those rights to other people publicly. So you're an owner, you have a claim on the company's assets and earnings. So you, as an owner, you have a claim on that. And as they do well, maybe they might pay a dividend based out of their earnings, every quarter giving you money back, or certainly you make money as your stock price rises up. Those are the benefits of being an owner. More risky being an owner because the price could go down, or they could cut the dividend, or go bankrupt, or all sorts of things. So a publicly traded stock is sold on a market like the New York Stock Exchange or NASDAQ or Nikkei, or all these different types of exchanges that are out there where stock is publicly traded and you can buy and sell stock. You have voting rights because you're an owner. Now, if I own one share of stock of, let's say, Google, and there's lots of shares out there, I have very little power on that, but you do have voting rights. Sometimes you'll get like things in the mail where I'll ask you about, to vote on something on the new board of directors or a change in the company or whatever. So sometimes you get voting things with there. But for most folks like you and I, it doesn't really impact that much as far as the company. But big major institutional investors where they might own, let's say, 10, 20% of a company, especially a smaller, medium type company, they're very, very strong and very powerful because they are owners in that company. Now, you're not involved with the day-to-day operations, so I'm not deciding whether the Google self-driving car is going to be released next month or something of that nature, but I want to be aware of what's going on with the company so I can decide whether I want to continue to own it or maybe I want to sell it and invest in something else. But you're not involved with the day-to-day operations. And the idea of owning stock, from our perspective, from an investing standpoint, is we want to get a return on our money. We like being an owner, that's nice, but we don't get lots of benefits from it. Really what we want to do is invest that money, have it grow, have it get a return on that investment, and then be able to later use that investment to fund things in the future, things we want to buy, a home or college or retirement or financial independence, or maybe leave some money to our heirs, after we die, to help set them up for their future. So there's all these reasons why we invest, and we invest in stocks to get a return. And one thing about investing in stocks is we're looking to get a better return because it's more risky. Stocks are more risky than many other asset classes or other types of things like bonds or cash, which is much more safe, for example, or gold or different things that you can invest in. Stocks is a part of your overall investment strategy and part of your portfolio by investing in stocks. And that might be a more riskier part of your portfolio, probably the most risky part of your portfolio actually for most people. And it's the one you expect the biggest return, especially over the long term. And that's why people invest in stocks, and we're really looking for long-term returns by being an owner, by buying the stock. So stocks can have real short-term way ups and downs as far as movements, but over the long term, they can be very, very successful compared to these other assets, and that's what we're looking for. So that's really what a stock is. And so if you own a major index fund, let's say like the S&P 500 fund, which is the 500 largest United States-based stocks, heck, you own all sorts of stocks from McDonald's to Coke to Google. So, congratulations, you're an owner now. Let's talk about the real basic essence of stock trading. What's really going on here? And at the base level, you have folks that are investing in stocks, and some folks want to buy stocks or buy more of a particular stock of a company, and other people want to sell that stock of a company. And when they reach an agreement on a price, I will buy it for this price, you will sell it for that same price, then we have a trade, right? I'm buying and you're selling, and now we've reached an agreement on price. In effect, we have a contract to sell. Don't really think of it as contracts, but it's really what's happening is we have an agreement. And I buy, you sell, or vice versa. And that's what's underlying what is happening is on the stock exchanges, we have thousands and thousands, tens of thousands of traders who are buying and selling all throughout the trading day. Now, when this occurs, something that's really underlying this is supply and demand. If you've had economics courses, you're familiar with supply and demand, certainly the supply and demand curve. But basically, when there are more buyers than sellers for a particular stock, that tends to drive the price up. The price of the stock will go up. And when there's more sellers than buyers, then the price will go down for that stock. And thus, when we reach the middle point, that's when there's an agreement on the price and we actually have a trade. But when there's, let's say, more buyers for something, maybe there's some great earnings news, or there's something, a pharmaceutical company had a great new blockbuster drug, and now people want to, are in a frenzy and want to buy that stock. Well, now the price goes up because sellers can get more for their price, is basically what's going on here because there's such high demand. Let's use an example here. If you think back to the early days of COVID, and we had the COVID lockdowns. Remember those dark days when people couldn't go to restaurants, people couldn't go anywhere, and everybody was locked down. And what happened with certain stocks in the stock market there was really a good example of supply and demand. People looked at a company like, let's say, Zoom with video conferencing, and they're like, well, everybody's locked down, companies have to work remotely, virtual offices. What's the company that really caters to that market? Well, of course, Zoom would be one of those companies, and Zoom stock zoomed right up in that period because of the change in the landscape due to COVID, right? So people are like, oh, well, I really want to buy Zoom. The Zoom price is going to go up, and then that drives the price up. And thus, if you wanted to buy Zoom, you were paying more of a premium price. On the other hand, due to COVID lockdowns, what was being really locked down, of course, was cruise lines or cruise ships. NCLH is Norwegian Cruise Line Holdings, or Norwegian Cruise Line. So if you're familiar with them, they're a big cruise line company. And before COVID happened, they were very successful. All the cruise lines were really near some peak numbers. They were doing great. And then, of course, when COVID happens, they all got shut down. They couldn't even sail because of the COVID lockdowns. Later, that started to open up. But in the early days, you couldn't go on a cruise. So what happens to the stock price? The price goes down. The cruise lines don't have really any earnings. They're just trying to stay afloat. If you get that kind of dark joke, they're just trying to stay afloat. So those are things that can happen in the external environment that can cause things to either rise in price or fall in price, in addition to whatever the company strategy is doing or how well they're doing, like with their earnings or their different ratios or what their stock chart might say. In the end, all that's kind of going on behind the scenes, the essence is we have buyers and sellers. And people buy and sell based on their outlook on the company. I mean, the last big thought to take from this is that when you have a buyer and a seller, that means somebody thinks the stock's going to go up and somebody thinks the exact opposite, that the stock is going to go down in price. And thus, we have the trade. But understand that no matter how enthusiastic you might be in a stock, there's another person on the other side thinking, maybe not so much. And that is the essence of stock trading. So where do stocks fit in a diversified portfolio? A portfolio being think of it as a basket of your holdings of your investments that you have, your various investments. Maybe you have some cash investments or bond investments, or you have precious metals like gold, silver, you have investments there, and investments in stocks. And within stocks, you have individual stocks or mutual funds or exchange trade funds, a lot of different variations, of course, on that. But your portfolio is basically your whole basket of all your holdings that you have as far as your investments. And so where do stocks fit in there, and how does that kind of relate to your risk tolerance? And a couple ways to look at it as far as building a portfolio. One is to think about how far away is your goal. If you're saving money, let's say, and you're investing money because next year you want to retire, let's say, for example, well, if you're buying stocks today that, a year from now you want to retire, that is a very, very risky move. See, stocks are, have a lot more volatility or risk, as in they go up and down frequently, actually every day, but sometimes they can have wide swinging periods of return. So stocks typically are looked at from a risk standpoint as far as a longer term investment. I've seen folks say like 3 years or more, or things of that nature as far as holding stocks. You might even want to be even going beyond that. But the idea of investing in stocks is a long term, think long term, versus, let's say, investing in cash where you get very little return on your cash, but it's something you can get at right away, and you're not expecting a great growth on it, but you're not expecting it to go down either. It's not going to go down 10% in a day like an individual stock may. So think about when you're building a portfolio, and where stocks fit in is how far away is your goal. The further away it is, the more stocks that you can have as far as a risk idea. Think about your risk tolerance, and there's various tools and things we'll look at online in the as far as different tools you can look at to determine your risk tolerance. But even without using a tool to figure out your risk tolerance, you kind of know in your gut a little bit, like, when stocks go up, yeah, everybody feels good about that. But how about when they go down? How if they go down 10, 20, 30%? What if your stocks went down 30% in 2 months? What would you do? Would you sell? Would you feel really uncomfortable about that? Or would you be enthused and want to buy more of the stock, thinking you're getting them on a bargain basement deal? So if stocks go down 20% and you look at it as, hey, what a great buying opportunity, I'm going to take some of my cash and buy more stock. Well, you're a very risk averse, or you're a very risk aggressive investor. You're like, I want to take on more risk to get more return. If it's down 20% and you feel queasy or very nervous about it, well, then you're more risk averse, and that's okay. Just the key things you want to understand is where you're at on risk tolerance. Stocks are more risky, and so the more stocks you have in your overall basket of investments, your portfolio, the more your overall portfolio will go up and down. Particularly that down part is how do you react when it goes down. So understand stocks are more for the long run and are more risky, and understand how that relates to your risk tolerance. Lastly, think about need too. When are you going to need the money? That's how far away is your goal. But what is it looking to do for you? Are you looking to invest in maybe stocks for a long period of time where you want them to grow and grow faster than inflation and grow very well because you're not going to tap into it for 20 or 30 years? Well, then you can take on more stocks, or you can take on more aggressive growth stocks. Or maybe you're like a retiree right now. Let's say you're going to retire in a year, or you're going to retire and you have a lot of income producing things like cash or bonds, which are made to give you income. Maybe you want to supplement that with a few dividend type paying stocks or dividend mutual funds, things that pay out income that are dividends, but they get you a little bit more growth because there's still a stock, still more risky, but less risky than, let's say, a high-tech stock, for example. But it's a less risky stock that'll still pay you every quarter some money or income, and you have that be a small part of your overall portfolio or basket of your holdings. So think about how far away is your goal, how is your tolerance for risk, and then kind of what you're needing out of this. Are you needing growth? Are you needing income? Are you needing a combination? Do you need safety? In that case, you might be have very little invested in stocks. So those are the three big things to consider to get you started with that. And the next lesson, we're going to look at some sample portfolios. Like, well, okay, this is nice, but do you got some ideas? Like if I'm a moderate investor or aggressive investor, what might be some ideas of returns and some ideas of some basic portfolios, what percentage to put in stocks and what percentage to put in something else to just at least help me get me started, at least start thinking around that? Well, we do, and that's the next lesson. So let's look forward to that next lesson and learn about different ways that we can make up a portfolio with a variety of assets, including stocks. So let's talk about where stocks fit even more into your overall portfolio. Your portfolio, of course, being all the different things that you invest in. Stocks, bonds, cash, maybe some cryptocurrency, all these different things. That's your overall portfolio, and stocks will have a component of that, or should have a component of that. So let's start by looking at risk and return, right? What's my return? How much can I make versus what's my volatility or risk? What's my chances I'll lose money? So these are different on this chart here. On the left-hand side, on the vertical, is potential return from low to high. The higher these circles are, the more return or better results you're getting. And then risk is on the bottom, on the horizontal, from low to high. More defensive, more safe on the left to more risky on the right. And if you look at these different types of assets or things you can invest in, you have some that are considered what are called defensive assets, kind of highlighted in the blue there, and growth assets, things that are going to grow your money faster, maybe faster than inflation. It's like a big idea we're looking for. But they'll be more volatile, more risky on these growth assets than more defensive assets. So we think about things like low risk, low return. Well, that's cash, right? CDs, money markets, things you're investing in cash. Bonds, also known as fixed interest or fixed income investing, those are still considered defensive, but they're going to give you better returns in cash, a little bit more risk. And then we go up the spectrum here. We've got property, more commonly known as real estate, a little more risk, a little more return. And then you have shares. Now, more commonly, shares are also known as equity. So if you've heard the term equity, or stocks, that's what they are. They're stocks. So shares, equity, stocks mean all the same thing. And you can see much higher return, but also more risk. And then there's alternative investments out there. Most famous one probably right now, I'd say, is cryptocurrency. More risk, possible higher returns. We'll see how that plays out. But, this is the kind of the continuum when you're building your portfolio of like, oh, do I want some real risky high growth assets like maybe crypto and stocks? Or do I also want to put in some bonds too that might, or even cash or real estate to help mitigate that risk, depending on how much risk you want to take. Somebody who's really, really into risk would say, give me a whole bunch of crypto and a whole bunch of stocks. And somebody who's like, no, I want to be a little more safe, a little more defensive. Let me work in some bonds in there. So let's look at some historical returns on a portfolio basis, just on some simple things, a simple stock and bond mixture, stocks and bonds, right? So simple mixture. And then if you want to be more risky, let's say if you got in stocks and bonds, well then add some crypto. And if you want to be less risky, add some cash, right? As an example. So let's say historically, if we look at these returns and if we say, okay, we want a portfolio of 100% bonds. We want to be defensive. We want to be safe. Our average annual return, it can vary a little bit by country and various things, but about 6.3%, at least over the last 96 years. There's a study done on this, so over the last 96 years. So about 6.3%, right around that 6% number. Years with a loss, that means 20 out of 96 years. If you just invested in bonds, super safe, you're still going to have a loss. Okay, well, let's mix in a little bit of stocks here. So let's say your portfolio was 20% stocks and 80% bonds. Still very defensive, but it goes up from 6.3 to 7.5. That's a pretty nice jump for just adding a little bit of stock. And then years with a loss, would be 16 out of 96 years. Did you catch something there on the years with a loss? Let's look at it a little differently. So if I'm 100% defensive in bonds, years with a loss, I would have a loss of 20 out of 96 years in this study, right? But if I added a little bit of stock, I'm only 16 of 96 years with a loss. Why is that? Well, because bonds, like anything, it has its own risk. And if you put all your eggs in one basket, as they say, if I only invest in bonds, I'm actually taking on a little bit more risk than if I added a little bit of stocks. So even just adding 20%, not only do I get the better return, I also get less years with a loss would be the idea behind it. So if somebody says, I'm just 100% invested in bonds, you might want to say to them like, man, you're taking on a lot of risk. You should have had some stocks, right? So now let's look at a very common portfolio, 60% stocks, 40% bonds. bonds. A moderate portfolio, a little bit more oriented towards growth. That's where you start seeing these average annual returns like around 10% or 9.9. Years with a loss goes up, 22 out of 96 years with a loss there. And you're going to get that much, much better return. And then if I was 100% invested in stocks, well, then my average annual return is like 12%, 12.3. Now, you might see more quoted in what I've shared some numbers around average being 10%. But if you add back in dividends, we're going to learn about dividends and things like that, where you get paid money just to basically own stocks. If you add that back in and reinvest that, you're actually going to get a better return and end up right around the 12%, which is actually what most people do is they reinvest their dividends versus maybe if you're retired, you might live on your dividends. And then years with a loss, 25 out of 96 years with a loss. So, as you can see, you can have some really good returns and you can balance your risk depending on your mixture of your portfolio. But as you can see, stocks is really the driver of long-term growth as far as growing your portfolio and growing your money. And so you can have money for your goals and in your future by investing in the stock market. So not only need to understand, how to kind of understand stocks and how to kind of speak the language and how to interpret some of this sometimes confusing numbers and things you might see out there. So we're going to look at stock quotes. So when somebody says, the Amazon is up 10% today, where are they getting that from and how to understand that and how to understand a stock quote. And we'll also look at a stock chart too, because I can kind of graphically show you how things are looking for a stock. We gave you a little preview with that one or a slide or two earlier. So stock quotes and stock charts may seem intimidating at first, but by the end of this lesson, they'll seem really, really easy, I promise you. And it helps you to kind of how you can look up some stocks. You can look up some stocks yourself that might interest you at the end of the lesson today that you can kind of do for homework. It's like, I'm going to show you examples, walk you right through it. And then you're like, well, I'm interested in this stock. You can now afterwards, after the lesson, be able to look it up and start comparing and really kind of get going right before we get into the next day, day 2. All right, so let's look at stock quotes and how those work. So first off, you need a place to find the stock quotes. So I have many students from all over the world. So the easiest way is to look it up within your own country. So put in like stock quotes in India or UK or USA or wherever you live. Put that in and you'll start getting back things as far as different services that provide a stock quote. Now, two that are pretty worldwide and very universal and easy to use are Yahoo Finance and Investing.com. And how the quotes and charts and everything look are essentially the same. This one might be laid out a little differently. So I'm going to show you Yahoo Finance because it's really easy to use and it's globally as well too. So that's why I'm going to show you some stock quotes and some charts, and we're going to use Yahoo Finance, but you can use other ones too as well. There's many of them out there. So if you go to that finance@yahoo.com, at the very top of the screen, you'll see where it says search for news, symbols, or companies. And you just type in companies that are interesting to you. So if you're interested in Tesla or Amazon or Facebook or whomever, you just type in the company name and you'll pull down a list and you can just find it very easy. We're going to look at, for fun, we're going to look at two companies here, two very different companies. We're going to look at General Mills, which makes cereal, amongst other things. They make food products. So like yogurt, they actually are starting to really get involved in pet food, for example, but they're very famous for their cereals, known as Big G, or Big G brand cereals, like Cheerios and Wheaties, and one of my favorites, Lucky Charms. Not healthy, but I like them anyways. They've got marshmallows in them. So General Mills. And then we'll look at HubSpot, very different company. They're customer relationship management software platform, very much oriented around like marketing and stuff. So if your company or a company needs to handle how to do social media marketing and organize all their different social media marketing, the software that can help do that is HubSpot. So they're more of a technology company. General Mills is more, of course, of a regular old food company, been around for a long time. So let's look at General Mills and HubSpot, and we'll look at their charts. Or excuse me, we're going to look at their quotes first. So if you go to Yahoo Finance, you type in General Mills, this is what it'll come back with. All right, so at first you might be thinking, what is all this stuff? No worries, we're going to walk right through it, right? So I'm going to start in the upper left. You, of course, have the name General Mills. Where it says GIS, that's what's called a ticker symbol. So you can just, it's a kind of shorthand. So instead of like in Yahoo Finance to search for General Mills, I could put just GIS. And it's just a shorthand for that. Like Johnson & Johnson is J&J. Sometimes you am referred to that way. And then you see the big thing, which is the price. So $63.79. And you can see, oh, it's up 0.3, and that equates to up 0.47 for the day. So for the day, this is how they're doing as far as in this particular day. So they're doing, pretty good, up 0.47 for the day. So that 6379, by the way, is the last price it's sold at. You may not pay that price. You may pay a little more, a little less, but that's the number they use for quotes and for charts and everything, is the last price it's sold at. And that, if you watch that, it'll constantly change almost every second throughout the day. So General Mills right now is trading or selling at 63.79. If we go down and then in the middle, this is the summary, this is the quote, and then you can see you can get into other stuff like charts, the conversation, some real deep statistics, profile will tell you what the company's about, that kind of stuff. Financials will show like income statements, but we're just going to look at the quote here. So if we look at this, we're going down the left-hand side now. It shows the previous close, right? So what did the end of the trading day, what did it close at? So it closed at 63.49. So we know it's up from there, right? At least as far as this time. It actually opened the day at 62.80. So that just tells you what was the first trade of the day. It was 62.80, and now the last trade when we took this screenshot was at 63.79. So it gives you a little information there. Now here's a little couple confusing things. So what is this bid and ask price? What is that all about? So simply, bid price is the highest price a buyer is willing to pay, right? So right now, the highest price a buyer is willing to pay is $63.38. Now this changes constantly too. Our last price somebody paid $63.79. When you actually go in to buy it, it might be getting close to that $63.79, or it might be more closer to around the $63.38. They're constantly changing. And how many people are looking at that price as far as that bid price is the 1100. So highest price right now somebody's willing to pay is $63.38. Now the ask price is the lowest price a seller is willing to accept. And these are usually very close. This is, you can see it's 63.48. So about 10-cent difference between the two. So yeah, that difference is what's called the spread, by the way. Have you ever heard anybody say, oh, the spread? That's the difference. And the closer the numbers are together, the more easier transactions are. You don't have a wide spread, you have a narrow spread in this case. So you can see that it's easier to have a meeting of the minds somewhere in the middle, maybe at 63.40. It's constantly doing where you can actually go in and buy stock. But that gives you an idea of the range it might be trading in at that exact moment in time. Then if we talk about ranges some more, you can see the range for the entire day. How is the day going as far as the lowest price to the highest price through the day? So you can see during the day it sold for 63.12. Somebody bought it at 63.12, and somebody paid 63.93 for it. Some human being actually bought it at this. And right now we're getting a quote of 63.79 would be the market price, or kind of the current price, or in fact the last price it's sold at. And that's in between those two. But it gives you an idea of the range. And then the same for the day. And then if you look at 52-week or the last year, it can show you a range. This is kind of helpful. Like, is the stock been up over the last year, or has it been is it more near the bottom of its range over the last year? And if we look at General Mills, 53.96 was the lowest to 66.14. So it's more closer to the high end right now. You'd be buying it near the high over the last 52 weeks. Volume is simply how many transactions there have been. So this is a pretty well traded big company stock, a large cap stock. You'll learn about that tomorrow, about market cap. And so there's been 189,000 transactions. This is early in the day, and you can see that's a lot of transactions. The average volume for the day, because we're early in the day when we took this quote, is a little over 4.4 million. So you can see we're early in the day, but we should average around 4.4 million. Some days are lighter, and some days are larger as far as the number of volume. The market cap, that shows you how big the company is in relation to other companies. So if you're comparing one company to another, the bigger that number, the bigger it's considered as far as in the stock market. Now tomorrow in day 2, we're going to go really into detail on market cap. So we're going to hold off on a couple things here, but we'll hold off on market cap till tomorrow. Now, beta is a measure of risk. All right, so you're wondering, oh, is General Mills a risky stock or a less risky stock? And there's many different ways to measure beta, or measure risk. And beta is one of the easiest ones, which is understanding how it compares to the wider market. And so and this is looking back over 5 years, looking at the monthly, change in prices, basically up or down. How much up or down is it? And so what this number is telling us is how does it compare to the broader market? In this case, it would be like a broader, largest 500 USA stocks, right? The S&P 500. So how does it compare to that? So if it matched exactly those 500 stocks as far as going up and down in price, how risky or how volatile, it would have a beta of 1.0. So if it matches the market, it would be at 1.0. If it goes up higher, and let's say if you're at 1.0 for the market and the stock was at 1.0, then they're going to move up together, up and down. You'll see them essentially move up the same degree or percentage together, whether it's up day or down day. If, let's say, it's above 1.0, let's say the market's always at 1.0, and let's say my stock's at 1.1, right? So that means when the stock market goes up, the broader market, my stock's going to go up even more. In fact, by a factor of 0.10 or 10%. So when the market's up, then this is going to go up because it's up 1 point. That's at 1.0. By the same token, if we start level and the stock market's down, then this is going to go down further by that same amount, down that extra 0.10 basically. So numbers that are above or greater than 1.0 are more volatile, as in they'll go up when the market's up, but they'll also go down when the market's down faster, or bigger ranges, right? So you might see that with like a lot of high beta technology stocks, for example, where they might go way up when the market's up, but when the market's down, they're really getting crushed. So General Mills, what was General Mills? That's 0.55. So it's kind of the same principle, just in reverse, right? So if it's going to go up, the market's going to go up. General Mills will not go up as far. It'll go up like 0.55. So it doesn't go as much as up on the upside. By the same token, if the market was down, let's say down, then General Mills is not going to go down as far either. So it has a narrower trading range up and down, which means it's basically less risky or less volatile. Less ups, less higher highs and less lower lows. It's kind of steering within a narrower range than, let's say, the wider range of the overall market. So if you like stocks, let's say, that are not as volatile or go widely up or widely down, then General Mills might be interesting to you because you're looking at that beta under 1.0. So to recap that, above 1.0, wider swings. Below 1.0, much less wider swings. In fact, 0.55 is a really low beta. So this is more of considered a very less risky as far as volatility, how much you go up and down stock. Okay, let's go back to our chart here. So if we look at this, now you're going to learn about some ratios. So we have a common one is the price to earnings ratio. And this is when it says TTM, that means trailing 12 months. So it's going back in time, looking at the price to earnings. And day 3, we're going to actually get in real detail on the price to earnings. Right now, to understand is it's a relation to what's the price I'm paying, the $63.79, for example, relative to the company's earnings. How is the company's earnings doing? Because earnings can be a real predictor of how the stock price will change. So a price earnings ratio averages right around 13 to 16. As far as price to earnings ratio for the whole market, it can vary by industry. So General Mills is right in there. But coming up on day 3, when we look at ratios and fundamental analysis, we're going to get in real detail on this. Just understand that when you're maybe looking at some stocks now, if it's above like 15, that's a higher price to earnings. You're paying more for those earnings, and you're paying more for that compared to a stock that has a lower price to earnings ratio. Basically, the lower the number, the better, but there's more to it than that, and we're going to learn about that. EPS is earnings per share, same thing over the last 12 months. So for each share of stock a person would own, so if I want to buy 1 share of stock, I'd pay $63.79 to keep it simple. And I would pay, the earnings per share is $4.12. So that's good. They're profitable, they're making money, actually doing pretty good. Right? So that's $4.12 per share. Earnings date, you might see something in here where it's showing when the next time they're going to update their earnings. Usually that's done quarterly, of course. And you hear about somebody saying, oh, I've got the quarterly earnings is coming out, right? And they disclose how they did in the last quarter. So a lot of times you'll see a date as far as either the date when they've announced they're going to have an announcement around earnings, or it's going to be a range. Sometimes they'll show a range giving you an estimate when the next earnings announcement will come. Now, the next one to look at is dividend. Now, not all stocks pay a dividend, and we'll learn all about dividends in day 2 here. But this is looking at how much you earn as far as a dividend or income per share and the yield, kind of a percentage number. So for now, just think, the higher that number, that especially in the percentage, that's 3.21, that's good, that's better. And again, not every company pays a dividend. Ex-dividend date, simply means that if I own this stock by that date, then they're going to pay me money. They're going to pay me that dividend. Again, hold on, day 2 is coming, 24 hours, we'll get really into dividends. But understand that you can actually earn money just by owning the stock, and that's the dividend. And the dividend date, if it's listed there, they'll show an estimate of when the next dividend date. And then a lot of times they'll also show a 1-year target estimate. That's kind of based on some, if stock market analysts or whatever, and they're compiling that together. So if we look at that, analysts are saying, okay, a year from now, they're anticipating it's going to be like $62.66. So that's kind of telling you that, like, well, wait a minute, General Mills is selling right now for $63.79. Why would I buy it? Well, you may not, at least based on analyst estimates. So the analysts are not right all the time. In fact, many times they're not right. So don't let that throw you, by the way. Just understand, especially if you're going to hold for a longer term than a year, you can just kind of look at that and kind of get an idea what they're looking at. And then to the right is the chart, right? So this is showing like a 6-month chart. And we're going to learn about charts coming up in just a moment, and we'll get into how to read a chart. But this just kind of shows how the prices have gone, in this case, over the last 6 months. And you can see that they've kind of gone down a little bit, and then they came kind of back up. So right now it's green, so they're up. So that's General Mills. We took some time to really go through, line by line on that stock quote chart. Let's do a quicker one with HubSpot. We'll go through that one quickly, and you can always rewatch this again to kind of get it all in together here. So if we look at HubSpot, you can see their ticker symbol is, yeah, that's right, it's Hub. Hubs, they're on the NASDAQ or New York Stock Exchange as well. Now you can see that their price is a lot higher, right? They are trading for $472.79. That doesn't mean it's a better stock, by the way. The price is sort of irrelevant that way. It doesn't mean, oh, I should buy it now because it's more expensive than General Mills. It's just showing what people are willing to pay for it right now. In fact, you can see it's down for the day. It's down 2.18%. And the previous close was at 483, and it opened at 486.55. So people are like, oh, let's keep buying this. But then it started coming down. Something has happened, or people are saying, oh, I want to get out of this, and it's coming down. You can see our bid and ask price is a little bit wider spread between the bid, highest somebody's willing to pay, and the ask, the lowest price a seller is willing to accept. So you can see that's kind of going up there right now. It's a very interesting thing versus the last price was 472. The day range, I mean, look at that day range. We went from 471 to 480. That's kind of a good size range as far as in the day. And then if we look at the 52 weeks, right around 198 to 574. So it's really had quite a run up over the last year. So if you bought in around 200, 250, you've almost doubled your money. So great there. And you can see that their volume and their average volume is only 537,000 average volume. Remember, General Mills was like 4 million. So different type of stock, more of a smaller 22 billion market cap stock, versus General Mills, which was around 38 billion. Now we talked about beta. Remember we talked about beta where if it's above 1.0, it's going to go up higher, but if it's below, when the market goes down, it's going to go down further, so much more risky, right? So if we look at the beta of HubSpot, you can see they're at 1.71. So again, they're going to have higher highs and lower lows, in comparison to the market. So if you're looking for a safe, not real risky stock, well, General Mills might interest you. If you're looking for more of a growth stock, more of a tech type stock, then a beta 1.71, then HubSpot might interest you. Price to earnings, I wanted to show HubSpot because it's going to show a couple things here. So price to earnings, we're going to learn all about that again in day 3, but it's price basically divided by earnings. So if you don't have earnings, let's say you're losing money, then it'll show NA there, right? Not applicable because they're not making money. So that's why if you were looking up some stocks in your home on your own tonight, and you see NA, that's why they're showing they're not even making money, at least over the last 12 months, in this case, trailing 12 months. And you can see that in earnings per share. How much have we made per share as far as the company has made in terms of income, revenue, or profit, really it's net profit. And you can see they've lost $1.99 per share. So that means the company that we're investing in is losing money. Now, many companies, especially technology companies or biotech companies and healthcare, a lot of companies lose money at the beginning, right? Because they're building their business. The early days of Amazon, for example, they lost tons of money. Tesla lost tons of money, but they were gaining market share, gaining, sales, and they were growing that company over time. And then when they started to turn a profit, then they start turning, big profits. You think about Amazon and the massive amounts of profits that they generate. But early on, they weren't generating those profits. So it's something to look at when you're looking at a stock chart. Will that company be able to turn it around and be able to, they're on the path to profitability, or are they really struggling and going down maybe even all the way to bankruptcy, which means we could lose our investment, or certainly our stock price would go down. So you can see here they're losing $1.99 per share. Same thing, you can have an earnings date in here. You can see dividend. What is forward would be what's expected dividend coming up and what's that yield. And we're going to learn about that again tomorrow. So you can see that not all companies pay a dividend, and because it says NA here, HubSpot does not pay a dividend. HubSpot doesn't pay you to own the stock, income coming into you. So if you wanted to rely on some income coming from your stocks, General Mills would give you that, where HubSpot would not. We're going to learn about price appreciation and dividends coming up in day 2, where show you how to make money in stock either by the price going up or having some dividends coming to you, and or both. So hang tight on day 2. But that's something that you would look at and say, oh, if I'm looking at dividend stocks, then I'm not going to get that with HubSpot. And you can see there's no expected dividend date. You have to hold the stock by because it's not applicable because there's no dividend, right? And then again, 1-year target estimate, 608. So people are still very, what they would call bullish, versus to think the stock's going to go up, versus bearish, think the stock is going to go down, bulls and bears. And so with HubSpot, they say, oh, well, okay, you're going to go up in price. And then again, we'll look at the chart here, and you can see over the last 6 months that they're up over the last 6 months, like General Mills too. But with stocks, you can see there's lots of peaks and valleys, right? Ups and downs. So it's a lot more up and down volatile than maybe other investments like bonds and certainly cash. So while we're talking about charts, let's go now dive in quickly, and we'll look at charts up here in this next part. So basically I clicked where it said full screen there, right in the upper right hand corner by where the chart is, and it brings up this full big chart. So let's take a look at the General Mills chart here, and we'll walk through how to read a stock chart, because it can seem very confusing at first, but we'll walk you right through it. So again, this is General Mills. They make cereals, and on the left-hand side there, I'm just going to look at this top ribbon here. They have some things where you can kind of add in indicators. We'll learn about some indicators in day 3. Like if I want to look at a moving average and have that overlay over the chart, I'm going to show you exactly how to do that, for example. Or if I want to compare 2 stocks against each other, or compare General Mills versus a wider market index, like the 500 large USA stocks like the S&P 500. Or if I want to compare HubSpot and General Mills together on the same chart, I can click comparison, enter in Hubs for HubSpot, or enter in HubSpot, and I'll show both on both charts. Shows upcoming events that are coming on here, and I'll show you that on the chart. And then you get to choose a date range. So where it says date range, you can click on that and actually put in specific dates. Most folks will just click on one of these preset dates here, and your range could be 1 day, 5 day, 1 month, 3 months, 6 months, year to date, 1 year, 2 year, 5 year, or however long the stock's been in existence. That would be max, right? And you can kind of click between them, and that'll change your chart looking at the date range. You can see how it's highlighted there for 6M. So this is a chart for the last 6 months for General Mills. Next, you can choose your interval. So this is 1D or 1 day. So each one of those little marks that we're going to look at is a day. So each one of those, like green, they're called candles, each green and red candle, each one of those represents a day below. I could change that to, if I was a day trader, for example, and I trade a lot during the day, I might change that to be more frequent, like maybe minutes or hours. Or I could change it if I was traded less, I could go to weeks or months. I can change that interval. Day is the real common way that it's used because we have, a trading day. So that's very common. The next, you can choose how the chart looks. These happen to be candles or candlesticks, which a candlestick, if we look at the chart now, shows if it's green, that means the closing for that day was up, right? So there's a wide trading range. You have the body of the candle, and then you have a wick at the top and the bottom, and that shows you the range of prices that a stock traded in on that particular day. If it's green, it means it ended the day up for the day from when it opened, and if it ends up red, that means it closed lower than it opened, right? So that's the idea between the green and the red. So think of green as an up day and red as a down day. And that's how these candles work. But I can change that look from candles to something like a smooth out line, for example, that might go on there, or tick marks. I can change the look of that. But candles is very common because they're very instructive as far as showing you open and closes and where some trends might be going. You have a drawing tool too, so if you want to draw some stuff on a chart, you can as well. So that's that top ribbon where I can kind of change my parameters. So I'm at 6 months on a daily interval, and I've got some candles here. So now let's look at the chart itself. So how you would read a chart is it's basically time going from left to right. The further back in time is to the far left. So if I was to go 6 months back in time, because it's a 6-month chart, I would go all the way to the very far left. And then the current day, I would go to the very far right. That's the current day. And you can see how prices change just constantly through the day. By the time I took the screenshot, General Mills was at 63.72, versus whatever it was before. I think it was 63.79. Yep, 63.79. So you can see on the right-hand side there is prices. That's going from the bottom to the top is, a price range or high to low in terms of prices. So if we look at over the last 6 months, General Mills is trading anywhere from about, $53, dollars to up higher above 63.72. Got up, it looks like, closer to 68 or so, but right now it's trading at 63.72. So left to right is time, top to bottom is price, and thus if we want our stocks to go up in price, we want to see them kind of going from left to right, from diagonally, kind of from low prices to high prices over time. If we look at the actual chart here, and let's start at the far left, you can see how General Mills was kind of, drifting down, right? It had this little period where it drifted down. Then it had this big, like 3, 4, 5 days of downward trend here. It went just way down. See how those red candle bars went way down, kind of came back a little bit, then floated around, then went way back up, right? Went way back up, and then kind of drifted down again. And then we had this long, stretch of, where things are kind of going up, throughout the day, right? So they're going up, or excuse me, throughout the chart, they're going up. So, and you can see, and that eventually led us to our 63.72. So each one of these things is a day as far as what you see in the day. Again, green would mean that it's up from where it opened, and red would mean it's down from where the price opened. So now you might look at something that looks a little weird, like this part here, where it looks like it's gone up in price, and then the following day it goes down in price, but then the candle colors don't seem right. Well, what happened is, let's say with this first one, it went up as far as, it opened at a higher rate. So you can see it opened at really towards the top, but it closed down. So it closed and a down towards the bottom of that candle body. But the same token, where it went way down in that one day, like way, way down in price, but it now shows a small little green candle there. Basically what that's telling us is that it opened way down, but the end of the day up for the day. But you can see from the chart, they have this big gap down. It went way down. So that's just something to understand when you're looking through these prices. It's how it opens for that day and how it closes for that day. Now the lines along the bottom, a lot of times you'll see, is each of them is for that particular day, because we're looking at a daily chart. And this shows volume, how many transactions are happening. And sometimes volume can tell us, like, when there's something dramatic happening, where a lot of people are selling or a lot of people are buying, you can see there'll be spikes, right? And you can kind of see in those periods where there's been dramatic moves either up or down. Sometimes it goes way up or down in terms of volume. So that's what that's telling us. And then lastly here, you'll see where it says those Ds. Do you see the Ds there? That's just showing that there's a dividend. So when we were talking about how you get paid income for holding some stocks like General Mills, that means every time you see that D, that means they're paying out a dividend. So when we look at HubSpot, you can see they won't have the Ds. So let's take a quick look at HubSpot. You can see General Mills. Now let's look at HubSpot. So the same chart in terms of timing in my settings. So I've got 6 month, 1 day, and then I'm looking at candles. And you can see their wider price ranges throughout their chart. And you see that one part there where they have this big, what we would call a gap up, where it really jumped up in price. Where it jumped right here, and there's a lot of volume on that day too. So all of a sudden it just leapt right up to, ended up being over $500, where before it was trading like, I'm going to guess they're about 440, the day before. So quite a leap. So something happened. There was some news or something, maybe, something happened. The company announced where all of a sudden people got excited. You can see how the volume just leapt right up, and then the stock price jumped up too. And then as we look at that, further on from maybe that break point there where it gapped up, it drifted down, then back up, and then drifted down. And you can kind of see how HubSpot moved as far as they go. But the same concept of, if I'm looking whether at General Mills or HubSpot, the idea of reading these charts is exactly the same. In fact, a lot of people invest in stocks or trade in stocks just based on the charts, an idea called technical analysis or charting. So there's different ways to look at stocks. We talked about like price earnings ratios and ratios, so we'll learn about that in addition to the charting part. So that's coming up, how to evaluate stocks. One thing that people struggle with sometimes is, what type of trader do I want to be? Which really gets down to, how often do I want to trade? Do I want to be a day trader, really trading every day, making little profits on many, many transactions or many trades, and almost that's kind of my job? Or do I want to be a little bit more part-time, a part-time trader? And there's all sorts of different types of traders in between, of course. Now, the good news is, if you've decided, great, and you feel comfortable with it. But if you haven't, or you can always decide later. You don't have to decide now. In fact, the course will really actually help you to determine what type of trader you want to be as you learn and go through the different types of lessons. When you start doing paper trading, for example, it's real helpful not only to help you practice what you're learning, but also to help you maybe decide what type of trader you want to be. And so you do paper trading, see what's working for you. And then when you actually start trading with real money and you get off paper trading, you start using real money, just start small. And then you can kind of develop those skills by starting small as well. So you don't have to decide that type of trading right now. And you can always change your mind. Maybe your circumstances change and you have more time to trade, so you want to trade more frequently than maybe you did in the past because things have changed in your life and you have some more time now. You can always change your mind. Now, when we look at trading and the types of trading, a lot of times it really gets down to time frames in terms of looking at things like stock charts and looking how often you're trading and all that. So they kind of go from like the scalper or arbitrage all the way up to like a buy and hold investor. And you can see the different types of things that are in between there. A scalper is like trading based on minutes and just small little minute changes and making tiny little profits each time, but doing lots of them to make big profits is the idea. Same thing with day trading, where you're trading throughout a day based on maybe minutes or hours looking at a chart, and you're making more trades. As you go up, or as you go through these bullet points, you're doing less trading, and you can see the time frames match that. Whether you're a swing trader or a position trader, you can see how that's different. Maybe you just want to be more of a part-time trader or investor, and every few weeks or months you might do some investing and some trading, all the way up to buy and hold, where you basically, it's less about active trading with buy and hold and more about more entries when you're buying with fewer exits in terms of when you're selling. So all these work. It's just a matter of what works for you, and then you want to apply it within that. I'll let you know that they kind of, sometimes some parts of the course will work better in other areas or for certain areas. All the stuff works. All the stuff is helpful. But some things like, if you're a scalper or a day trader, that technical analysis section, that charting section, that's real important because you don't have a lot of time to wait for dividends or earnings announcements. You're making more frequent trades. Or if you're more of a part-time investor or buy and hold investor, that's where the fundamental analysis might become, weigh a little bit more than, let's say, the technical analysis. If you think, Tesla is the company of the future and you don't care what it does going up and down, you just want to buy it and hold it for the next 20 years, the fundamentals will be important, less so than the timing around like the technical analysis or the charting. So the good news, you can use all the stuff from qualitative, looking at the vision and strategy of the company, to fundamental analysis and technical analysis, but certainly certain time frames match up even better. And really more so what we're talking about is that technical analysis part, going all the way up to the days and weeks, position trading, scalper, day trading, swing trading, position trading. Technical analysis becomes, very, very important. Even part-time trading, as far as intro, ins and outs, using the technical analysis, and fundamentals are always there as well. So again, you don't have to decide what type of trader you want to be. But if you're thinking right now, oh boy, I really want to be a day trader, then really focus on that technical analysis section, for example, so as you go through the course. Let's talk about how to choose an online stockbroker and some tips around that and what to look for when you're looking for your stockbroker that you want to work with. Now, there are still, full cost, expensive stockbrokers out there. There are certified financial planners and other types of advisors who can buy and sell stocks for you. They tend to be more costly, but they can give you maybe more direct advice. You're going to learn stuff in the course. You won't need to engage with them, but if you want to, you can. But you'll be able to just place your own trades as well. That's the goal of the course, so you can do all that and thus save a bundle of money. But if you want to use full-time people, you can do that too. And by the way, the tips that you're going to be in here, you really could apply both online or more face-to-face as well. But we're going to focus on how to pick an online stockbroker. So the first thing you want to do when you're searching is you want to make sure they're available in your country. That's the main thing. You could have people say, well, you should use ABC stockbroker. Well, if they're not available in your country, it doesn't matter. You can't use them. There's regulations around that. So you want to make sure they're in your country based on the regulations that they're regulated, and then also everything will be in your currency. You don't have to try to convert the currency or anything. Will be in your local currency, whether that's rupees or euros or dollars or yen or whatever your currency is. So when you Google, let's say do a simple internet search, they'll come up with ones that are in your country, or otherwise you could put in online stockbrokers and then your country name, India, US, whatever it might be. So first thing is make sure that you're available in your country and that you can even use them. Next thing is you want to, and this goes all throughout, is the level of trust, right? Bigger companies with a lot of reviews online, things that you've heard of, there's a lot of trust around them. Like TD Ameritrade, eToro is popular with a lot of students. Interactive Brokers, are real popular internationally. Big mutual fund companies like Fidelity, Vanguard, Schwab. These are companies that have been around a long time, and they're really well-known companies and very established. So no matter what country you're in, look for something that's maybe big and established. In addition to the features and things we're going to talk about in a moment, but in the end, if you can't trust them, if you think they're maybe kind of a scam, if the word scam comes in your mind at all, you need to find a different broker. Don't even start with them, because it's all about trust. It's your money, so you got to trust them that they're not going to rip you off. Then think about, what type of investor are you? Are you, getting back to that, are you a real active trader, or are you more of a buy and hold trader? If you're a very, very active trader, then you want to go with a broker that's going to give you a lot of features around charting and technical analysis and things like that. If you're more buy and hold, then it's less important for that. Maybe you're looking for more things like education or ease of use or their mobile site or something like that. So, think about how you want to invest, and then when you're evaluating the company, then look for those things that you're looking for, that you're specifically looking for, that they're going to meet those needs. So think about what type of investor you are will help determine what type of broker works for you. And a lot of that comes back into the next thing, which is the user interface, right? Some are very simple, easy to do. You buy, you sell, that's about it. Maybe some confetti falls down when you make a sale, or you buy a stock, whatever. And others can be really complex with a lot of charts, a lot of technical analysis stuff, a lot of tools, and which can be overwhelming for some folks. So again, look at that user interface and decide, what works for you. As you go through the course, you're going to learn so much stuff. So you're going to be comfortable with pretty much anything, but in the end, it's still a personal decision as far as the user interface and what you feel comfortable using with. The other thing is look at what types of accounts are available. A lot of them are just, traditional brokerage accounts. I buy and sell a type of accounts, and it's with money that's already been taxed or whatever. It's after tax money. But some might offer like before tax accounts, like retirement accounts or savings types of accounts, where you can trade within a retirement account. In the United States, we would call that like an IRA, individual retirement account, type of thing, or 401k rollover. Those are just some of the type of accounts, and different countries have different types of accounts that might be more a retirement type account versus something that's not a retirement account. Even though you might be using it towards retirement, you might have some tax sheltering ability. So look for the type of accounts that the brokers offer, and does it meet your needs as far as where you want to, the way you want to have your money held in terms of the type of account. The other big thing is looking at fees. There's fees, could be account fees just for opening an account or holding a certain amount of money in an account, having minimums. Trading fees, are you paying a fee for each trade, each buy and sell? Are you paying a trading fee? Is there miscellaneous fees? Is there fees for like wire transfer monies or withdrawing your money before a certain time? Is there penalties around that? We're seeing a lot more of no fee, no transaction fee trading, by the way, which is great. In one respect, there's might have a little higher spreads, or there's some profit for the company behind the scenes, but it allows you to trade more frequently than if you're paying, $2 or $3 or more per trade. That's going to be much more limiting for you, whatever your currency is. So look at fees. It's very important. A lot of times you can test drive a free version of your brokerage account. Many of them are just free all the time, and they make their money on fees. But others might have a pay version or a pro version, where in addition you pay maybe a monthly amount in addition to other types of fees or other types of costs. So test drive the free version first if they have that, to see how it's working for you. That user interface has got all the tools you want before you start paying for a pay version. And take a look too. Well, what if I cancel my pay version? Am I locked in for a year, or can I just end it right away? That's the thing to look at. And then take a look at the analysis tools that are out there, both from a fundamental analysis, ratios, those types of things, PE ratios, all the dividend ratios, and then the technical analysis or charting stuff, from moving averages to candlesticks, all different types of tools that you can use to analyze. Again, as you go through the course, you're going to learn all these different analysis tools. You're going to have some that are going to be more popular for you, or going to work better for you because you like them better, and then you just want to make sure your broker provides those tools that you like. So good first step would be to really go through the course and then start looking at the broker ideally, but in between you can look at some lessons ahead of time and compare to what your broker might offer. Another big thing that I'm real big on is paper trading. Do they have paper trading available where you can practice before you actually use real money? Many brokers, most brokers offer this because they want you to practice. They want you to practice on their site. So this is the other benefit of paper trading on a brokerage site, is you're actually using their tools, and you get to kind of test drive it before you start putting in your own money. So see if paper trading is available, so you can kind of give a test drive and practice while you're learning, but also learning on the brokerage site that might interest you. In addition is education. Some brokerage sites are very bare bones, don't give you anything, and some are very extensive in terms of education, and they'll really promote that. Now, you're going to learn a lot, of course, from this course. Maybe you'll take some other courses from me, which would be wonderful, would be great, but also your broker might be able to provide some education too. And are they providing education that's really only about how to use their site, which is nice and helpful, or are they providing education on other things that might be interesting, or blogs or other types of information that might be of interest to you and you might be used in your evaluation? And then, how easy is it to deposit and withdraw funds, right? Are they using the currency you want to use? Is it easy to move money in? Is it really easy to move money out? Sometimes it's easier to move the money in. It's a little harder to get it out. So look at those types of rules and things like how to deposit and withdraw funds, and what works, how that brokerage firm works, and whether it works for you. And then customer service. Some brokerage firms are real famous for customer service and really talk a lot about that when you hit their website. Others not so much. And you can look at things on the internet, and you can look at forums, or just Google search your customer service for ABC broker, and you'll find all sorts of things. Now, do remember that people are posting things on the internet are probably unhappy for some reason or another. So it may not be just that company. It may be this, they're unhappy and they're taking on the company because they made a bad trade. But if you start seeing things where, like, I can't get my money out of this company, and you see that over and over and over again, then that's a little more scammy and something to be aware of. So customer service could be very, very important in terms of your brokerage thing. So those are some of the things to look at as far as when you're evaluating a broker. And again, you can always pick one, and you can always change your mind. That's the best part. It's best to make a good decision the first time, because then you don't have to change your mind. But if you have to, you can always get your money out and try a different one.